Oh, thank you everyone for joining the panel today, joining the webinar today, as we discuss monetization of the 45Q tax credit. As you know, in August, the U.S. enacted the Inflation Reduction Act, which includes critical provisions for enhancing the IRS Section 45Q. The enhancements involve lowering carbon capture threshold, increasing tax credits, direct pay, and transferability. Today, but now what's next? So today we will feature a panel of experts that will discuss monetization of 45Q. And we have experts that have specialization in the areas of credit maximizing structures, CCS project development, finance structure, and regulatory analysis. The structure, our panelists include Ben Reiter, associate at Nixon Peabody, Ellen Friedman, partner at Baker Botts, Barbara DiMargine, partner at Baker Botts, Matt Cattell, managing investment officer at US DOE, Michael Plattner at a senior counsel at Van Ness Feldman. Format of the webinar today will be, first we'll have our panelists in the order which I mentioned, Ben, Ellen, Matt, Barbara, and Michael, to give us a little bit of an overview about themselves and of their organizations. Then we will go in, Ben will give us a 10-minute overview of 45Q tax credits, what happened. And then we'll go into a moderated discussion led by Ellen Friedman of Baker Botts. And then we'll leave some time for Q&A. So with that, I'll ask each panelist to give an overview, starting with Ben, Ellen, Matt, Barbara, and Michael. Thank you.
Yeah, thank you, Ruth, and thank you for having me today, and thank you to the Institute for organizing the panel. Exciting times in the CCS world. My name is Ben Reiter. I'm an associate at Nixon Peabody in Washington, D.C. My practice focuses on energy regulatory and project development matters, and in the last year and a half, that's increasingly meant CCS projects and clean hydrogen projects.
I think we're all, yeah, sorry, I think my camera is not on, but I'm a partner at Baker Botts with a particular focus on energy transition projects. And I'm going to try to keep as much time as possible for the substantive discussion.
Hello, everyone. I'm Matt Cattell. I am a managing investment officer with the Loan Programs Office at the U.S. Department of Energy. Since 2015, I've been working on the team focused on the carbon management projects. And a lot of those have been upstream projects, carbon capture projects. Since April of this year, I've switched gears to focus on the midstream portion so the pipeline and CO2 transport. So it's a really exciting time at LPO, a lot of authority and a lot of opportunities. So I look forward to today's discussion and hopefully being able to work with many of you on this webinar today. Thank you.
Hi, I'm Barbara DiMarigny. I'm a tax partner in the law firm of Baker Botts in the Houston office. My practice is focused on energy taxation, and in the last few years, I've been very focused on 45Q and hydrogen as and the tax incentives related to carbon capture and hydrogen.
Good morning, I'm Michael Plattner, Senior Tax Counsel in the Washington office of Van Ness Feldman, an energy and environmental law firm. I have been working on 45Q issues for about the last 10 years, was very involved in, on behalf of clients in the 2018 amendments and the IRS guidance from that, as well as in the amendments that were just enacted in the Inflation Reduction Act. Thank you.
Okay, now Ben, over to you.
Okay, so I'm just going to start off with a high-level overview of the big changes that the IRA brought about to Section 45Q. I'll try to get through it fast to save as much of the substantive discussion for the experts that have been working on these issues a lot longer than I have. But I think the best place to start is the timeline. The IRA kicked out the 45Q began construction timeline until 2033, sort of giving developers a full 10 years to put these projects in service and get them started. I'll probably have gray hair by that time. The other big addition, or well, one of many big additions, was that the IRA just boosted the credit amounts for 45Q. I don't know how much analysis it needs other than to say that there's a lot more money there. $85 per, and this is all assuming, and I think the panel will get into this, assuming prevailing wage and apprenticeship requirements are met. But if that's the case, you get $85 per ton for sequestration, $60 per ton for EOR or utilization. Direct air capture DAC has its own credit amounts, $180 per ton for sequestration and $130 per ton for EOR or utilization. So more time, more money, and it should be fewer problems as well, because the IRA just provides a lot greater flexibility, particularly with respect to qualified facilities and how those are defined. I think at a high level, a big deal with the qualified facilities is it takes away the 5,000 ton per year capture requirement for electric generating facilities, and it replaces it with a just 18,750 ton requirement and a capture design capacity of at least 75% of baseline carbon oxide production on a per unit basis. And I think, Jessica, we're on the next slide now. There we go. And I think the panel will probably get into what that capture design capacity means and how that's measured. The IRA amendments to 45Q provided a little bit more guidance on that, but I think probably subsequent guidance will also be needed. DAC facilities, they just have to capture 1,000 tons to be eligible, and then everything else just needs 12,500 and you are good to go. So more monetization options, and that's really what I think the heart of the panel is about today. And it reminds me of a discussion, a panel that was actually at the Institute's, I think it was June forum, their annual forum. And it was a great panel, a lot of tax equity investors. Discussion focused on, what do we need to do to get tax equity investors comfortable with these big, fairly new, fairly risky projects. And the answer at the end of it, I think, at least from a Poly standpoint, was, well, let's not do that. Let's just get direct payment in there. And the IRA gets us part of the way home there. States, local governments, your 501c3s, TVA, electric co-ops, your public power entities, they are all eligible for direct payment for the full 12 years of the credit. But then everybody else gets direct payment or may elect direct payment for at least the first 5 years of the credit. So that's not nothing. And then you can follow that up, or you could just take this from the beginning with transferability, the ability to sell or transfer your 45Q credit to an unrelated party. And then the Infrastructure Act actually made it possible for carbon capture facilities to be financed with private activity bonds. The catch with it under the Infrastructure Act, passed in November 2021, was that you took a 50% haircut, or up to a 50% haircut on your 45Q credit. The IRA came in and slashed that haircut down to 15%, making private activity bonds a much more realistic financing option going forward. And then, this last slide is kind of outside the it's outside the spectrum of 45Q, but the IRA brought into view a number of other potential financing sources for carbon capture projects. I think the big one, or at least the big ticket item, is the Energy Infrastructure Reinvestment Financing Program, the 1706 program. And that provides $250 billion in loan authority. I think that's right. I've read it about 10 times. I'm pretty sure it's not a typo, but Matt can correct me if I'm wrong. To retool, repower, replace energy infrastructure that has ceased operations or to enable operating energy infrastructure to avoid, reduce, utilize, or sequester air pollutants or greenhouse gases. You could see how carbon capture projects might fit particularly well, I think, in that second bucket there. The IRA also introduced a new clean hydrogen production tax credit. And to be clear, this is a credit that you can't take, at least at the same facility, along with 45Q. But you could just decide that you're in your production of blue hydrogen to take this credit instead. I think there's some question about whether you could maybe delineate the facilities where you're taking 45Q and 45V as well. That will probably have to be addressed under additional guidance. And then the ITC, the PTC, usually used for wind and solar, those are transitioning out to these new zero emissions tech neutral credits in 2025. Based on some of the definitions that are included in them, I think there's some questions about whether a high performing carbon capture facility might be able to fit within these credits in the future. So that is a pretty high level overview of some of the IRA changes in the CCS space. With that, there comes, as you can tell, like a lot of questions, as I'm sure a lot of people are sorting through. But luckily, we have a fantastic panel that I think will answer all those questions, or at least they'll shed some light on them in a way nobody else can. And so with that, I will turn it over to Ellen.
Okay, terrific. Okay, great. Thank you so much, Ben. That was great. So I am going to take the opportunity to sort of fire off a whole bunch of questions to our tax experts and our DOE representative here with, and there'll be an opportunity to listen to this again, because I'm going to do this really quickly. And at the very end, there'll be kind of the slide with our contact information if there's more you'd like to discuss. I'm sure we're all eager to hear your questions and dig in with you. So without further ado, the first question, Barbara, can you briefly describe this new two-tier approach that's been taken under the IRA? And it applies to all credits, but in particular with respect to 45Q, and how taxpayers seeking to benefit from 45Q are going to get comfortable that they've actually satisfied the prevailing wage and apprenticeship requirements that are required.
Sure. So as I understand it, it was a political necessity to get in order to get all these wonderful climate related tax incentives into the IRA, that they connect the credits somehow to jobs and wages. And so what we have ended up with is, for almost all of these clean energy credits, a two-tier system where the base amount of the credit is actually 20% of the credit number that everybody is sort of thinking about and going for. So for example, if you look at, now everybody's talking about, and Ben mentioned, $85 a metric ton for 45Q for carbon capture. If you look at the legislative provision, if you look at the statute, the number that's on the page is actually $17. Only when you look back to 45Q subsection H do you find that there is a 5 times multiplier for the credit amount, and that 5 times multiplier, it specifies that 5 times multiplier applies if you meet the certain requirements related to payment of prevailing wage, payment of prevailing wages, and use of apprentices in the construction, alteration, or repair of the facility. And so everyone is studying these provisions, and we're looking for guidance from the IRS about exactly how those rules are going to apply. One thing that's really interesting is that it says that, you know, they didn't want to have everybody have to feel that they had to comply with rules that we just had the bare bones for, and we didn't have a lot of guidance about them. So these rules, the multiplier doesn't act, you're deemed to have satisfied the prevailing wage requirements if you begin construction of your project before the IRS publishes guidance with respect to these requirements. And actually, it's if you begin construction before 60 days after the IRS puts out this guidance. And currently, the IRS is saying that they're going to give us guidance by the end of the year. So that would mean that if you begin, if they do that, that would mean if you begin construction on your project before the end of February, for example, you would not have to worry about meeting these requirements. Everyone else, if you don't begin construction, you begin construction later, then yes, you're going to need, in the construction, alteration, or repair of your facility to begin, you're going to need to pay these prevailing wages. And the prevailing wages, I understand that we have some people in the audience that are in Europe and may not have seen this sort of reference before, but it's a reference to mandated specified wage amounts that are that have been put out by the government and have been used actually for quite some time for any type of construction of any federal project. People had to pay these prevailing wages for laborers.
Okay, great, Barbara.
Sorry,
Thank you
so
so
that's a
much.
sort of long answer.
Yeah,
Sorry.
very thorough. I appreciate that. And just quickly, Matt, is it correct to say that if you are going to be taking money from the DOE under one of the DOE programs, that you administer the same prevailing wage requirements, you know, previously applied?
Yeah, essentially, any funding recipient from the department needs to comply with the Davis-Bacon labor rates. And so those are rates established by the U.S. Department of Labor for particular job categories and particular localities, and it's updated periodically. So that's kind of the floor price that you'd have to meet, and that's something that we will require you to report on during the period of construction and performance of your project. Okay, great, thank you. Mike, I'm going to direct the next one to you. I know that there had been some pushback in Congress about EOR versus Class 6 sequestration. Under the IRA, there doesn't seem to be any distinction, you know, other than the pricing. You know, do you care to comment on any of the sausage making here, or what might happen in the future in that, you know, respect with respect to EOR?
Michael, you're muted.
Sorry, just realized that. So yeah, no, there were no changes to the differentiation between enhanced oil recovery and just pure geologic storage. You know, other than the fact that there is a larger differential now when you go from $60 for EOR to $85 for secure geologic storage. But that's been in there since the 45Q was put in law in 2008. There's been a differentiation, and that mainly is because there is some value to that carbon dioxide that is used in enhanced oil recovery, and so the capture owner will usually be able to at least receive some of that value if they do sell it to an enhanced oil recovery operation.
And here's a question: is there any prohibition if you, during this 12-year class credit period, decide to switch from EOR to Class 6 or back during that credit period?
No, I mean, if you really your credit value depends on how you sequester it. So if you were to change sequestration and could now show the amount of credits that you are sequestering, let's say you're doing for secure geologic storage without EOR, you could then qualify for the credit at that value for those tons of CO2 that were sequestered that way.
Okay, so there's lots of flexibility. Barbara, you touched on this earlier. There is, this beginning construction concept. There is guidance that was issued, I think in 2020 on this. But if you were a taxpayer looking to undertake a project that would benefit from 45Q, what actions would you have to take specifically, and when would you need to take them to ensure that you would benefit from this program?
The beginning of construction rules in the world of renewable energy and clean energy projects are very technical and very, it's sort of a term of art. So there is a lot of learning and lore around exactly what beginning of construction means. There was first a lot of guidance in the wind and solar space with respect to what beginning of construction means, and that was revised specifically for 45Q in Notice 2020-12, where the IRS gave us more specific rules about what beginning of construction means for, or the safe harbors for when you will be deemed to have begun construction. And basically, there are two ways that you can satisfy the beginning of construction. There is the performance of physical work of a significant nature test, and then there is payment of 5% of the total costs of the project, incurring 5% or more of the total cost of the project. And then there are a lot of specifics around those two rules, but that's now the interesting thing is we don't actually know that those rules, which were developed for beginning of construction for general purposes, for when you begin the project, whether those rules are the same beginning of construction rules that are going to be applied for purposes of this beginning of construction before there's guidance on prevailing wages. But we believe that when they put that guidance out, they're going to echo or indicate that those rules are the rules that apply for determining beginning of construction.
Okay, great. So Michael, I'm going to bundle these two questions for you. First of all, are there any limitations on the amount of funding available to support 45Q from the government? And then secondly, well, I hate to ask this question, this comes up a lot. Is there maybe you could discuss the possibility that if there is a change in administration, something might affect the credit in effect today, and what you might address, what you might handicap that possibility to be.
Sure, happy to do that. So as to the first question, no, for most tax credits, there's no upper limit on the dollar value of credits that can be taken across the board. As long as a project meets the requirements of the credit and earns that credit, they are allowed to take the credit. There are a couple of credits where they actually have put in place a dollar cap on the total value of those credits. And they usually do a program where they have an allocation that you apply for and receive that allocation, and then that does limit the value of the credits potentially. 45Q originally had a limit because it had a 75,000 ton cap on the amount of tons of CO2 that would qualify when it was put in place in 2008. But they eliminated that in 2018, so that opened the credit up. So it's fully available to folks as long as they qualify for it. To the second point, I don't see really any possibility that a change in administration is going to impact this credit. There could be some changes around the edges. In 2008, when it was enacted, you had a Republican in the White House And Senator Max Baucus was chairman of the Senate Finance Committee. He sponsored the proposal. 2018 changes were very bipartisan. You had senior Democrats, senior Republicans sponsoring the bill that was enacted. And then the 2022 changes, while the bill itself that was passed was a partisan bill, everything that was in that bill had been parts of bills that had been introduced during this Congress and the last Congress on a bipartisan basis. So it had strong support on both sides. So I really don't see that being an issue going forward.
Okay, sounds good. All right, I mean, we have a lot of questions and we're already almost halfway in. Maybe Barbara, we could just quickly discuss the credit stacking and some of the rules here with respect to some of the credits highlighted by Ben at the beginning, and how you might see guidance kind of carving up or taking a distinction between certain facilities that are part of co-located facilities that are sort of designed to work in concert, but maybe, standalone facilities for purposes of the various credit regimes.
Right. So we've gotten lots of questions, and a lot of questions have come up from people that are looking at the IRA provisions and recognizing that now there are other credits that may somehow be available in connection with a carbon capture project. And is it possible to get not just the 45Q credits, but some of these other credits as well? And so there are specifically sort of three areas or three places in the IRA on these new credits where they specifically call out and say that a 45Q credit is, or the other new credit is not going to be available if 45Q credit is claimed for the same facility. And those, I would put them in three buckets. One is the new section 45V, like Victor, credit for clean hydrogen production has a specific provision that says it's 45V subsection D that says no credit under 45V is available at a facility which includes carbon capture equipment for which a credit was allowed to any taxpayer under 45Q. So that's a facility which includes carbon capture equipment. And so the immediate question that everyone has is, well, is the carbon capture equipment that I have at that facility, is it at the same facility? And should it be counted or held against me? What if I've got a situation where I've got some carbon capture activity that's co-located with my hydrogen activity, but it's not necessarily related to the hydrogen production. And so this is one of the areas where we are going to be asking the IRS for a lot of specifics about exactly how you're going to decide what's the same facility and what isn't the facility. And then just quickly, the same question comes up under 45Z for Zebra, which is for the clean fuel production credit. There's a reference to not getting that if you've got 45Q at the same facility. And then for projects which begin construction after 2024, you're going to be in the new section 48E and 45Y. And both of those new zero emission credits also call out, unavailability of those credits if 45Q is taken at the same facility. So,
yeah, so it's going to be interesting to see what the guidance is on that, because it could really expand the possible credits received for these complex projects that are being planned by emitters and others. I mean, I'm going to jump to the next section in terms of monetization. We we can circle back if we have time at the end to talk about more of the maximization discussion, but let's flip to the monetization. So Barbara, maybe you could set the stage here. 45Q is available to taxpayers that fill in the blank.
45Q, the 45Q credit is attributable to the taxpayer that owns the carbon capture equipment. So the credit flows in the first instance to the party that owns the carbon capture equipment. And if that happens to be a partnership, then the credit flows to the partnership that owns the carbon capture equipment. We've gotten a little guidance from the IRS last year, Revenue Ruling 2021-13, where the IRS gave us more description about its view of what is carbon capture equipment, and specified that in a situation where you had two parties owning pieces of the carbon capture equipment, basically that either one of those parties could be the one that claims the 45Q credit, although there is a restriction in that there can only be one claimant per carbon capture process train. But those are the basic rules.
Okay, so as Ben mentioned earlier, there's two new concepts in the IRA for monetization of credits. One is direct pay, and one is the transfer of the credits to a third party unrelated taxpayer. And maybe Barbara, you could explain why someone would opt for direct pay over a credit transfer, some of the pluses and minuses.
Yes, absolutely. So in direct pay, the big advantage is you get 100 cents on the dollar for your credit. So you make the direct pay election, you treat your credit amount as though you had paid that amount of tax into the government. And when you do not have a tax liability, when you fill out your tax return and show that you don't have a tax liability against which to use the credit, you get a refund, you get money. So that's the big advantage for people that otherwise can't use a credit because they don't have a tax liability. They can have this credit treated as though they had paid in tax and get a refund.
And that's only available to taxpayers that are not the special tax exempt types for 5-year strip,
right,
as opposed to 12 years. So, and then why would someone opt for transfer over, let's say, over the tax equity financing model, which was the subject of an earlier safe harbor guidance that sort of modeled upon what is more familiar with tax equity investors and in the wind space in particular. Why would someone want to do a transfer of credit and not a tax equity partnership?
Oh, you mean, okay, so we're going to talk about transferability as opposed to tax equity instead of
mixing up the questions here.
Okay, all right. So the in theory, I mean, this idea of transferability is a new idea, and so the idea is that it's going to be a much simpler sort of one-time transaction, that you enter into an agreement to make the election to transfer the credits, and you don't have to set up a partnership and have all the lawyers and accountants do all the brain damage to figure out whether or not you're meeting all the requirements for having a tax equity partnership allocation respected. And so the thought is that it will be administratively simpler and less expensive and more straightforward.
Okay, so why would anybody opt to do a tax equity partnership? And maybe Michael, I'll direct that to you. Given that we now have all these other options.
That's a good question. I really think that there there probably are going to be very limited circumstances, although you may have a situation in which you've got a project developer that hasn't been able to get the kind of financing he needs from the regular markets. And by going to the tax equity market, you still do have depreciation. So you've got that side of the tax expense that the project developer may not be able to utilize and benefit from. And so therefore it may be worthwhile for him to go to the tax equity markets. And I suspect he may get a little better rate combining both the tax credit side as well as the depreciation side. So it's going to come down to really what those project developers see and what's out there in the marketplace for them, what direct pay would benefit from, and what they might have to pay if they don't have direct pay benefits. If they could just use the transferability, how much is it going to cost them for transferability versus tax equity? And then how's that depreciation benefit going to factor into that?
Yeah, we really don't have a market sense for the discount to the credit value from the world of potential transferees. I guess to use as a in comparison. I mean, in terms of.
I was just going to say that one other point we should make here is that one of as you pointed out, the downside to the direct pay for 45Q is that you only get to do direct pay for the first 5 years of the 12-year credit period. And so for people that are looking at that situation and thinking, well, that may sound good for the first 5 years, but what am I going to do for years 7 through 12? And so one of the reasons that a tax equity partnership or transferability may be preferred over the direct pay is that, if you can negotiate it, it could be a solution for one fell swoop. It's your solution for 12 years of incentives. So you don't have to rethink what's going to happen 5 years out.
Maybe Barbara or Michael, you can comment on what is pay-go and the commitment that one would see typically being requested or required of the tax equity investor on the one hand versus the commitment by the transferee in what we might anticipate in a transfer credit arrangement.
So in a transfer situation, you are agreeing to make an election to transfer, and the election can only be made, each year as those credits arise for that year. So the money, the statute says that the credit has to be transferred for cash, but in theory, that cash could be paid to you upfront, or it could be paid over time. But in the tax equity world, there are very specific pay-go limitations or guidelines about exactly when that money and how that money can be paid in over time.
So if you were to get money up front from the credit transferee and the project did not produce the credits at the pace or in the quantity that was anticipated, what do you think that the contract would say with respect to the overpayment?
Right. Presumably, we're gonna learn that the IRS's view is that it's permissible to have a sort of a true up or an adjustment in the payment amount or a refund of the payment amount to the extent credits aren't available.
But in the case of a traditional tax equity partnership, the tax equity investor has to be kind of along for the ride as an owner.
Exactly.
And they're only getting direct pay-go with respect to 50% of the value, as opposed to 100% effectively direct pay in 100% pay-go in a transfer scenario.
Exactly. Yeah.
Okay. Michael, I'm jumping ahead a little bit. The tax exempts and their ability to utilize direct pay for 45Q and all of the the balance of these energy credits, is a really interesting part of the IRA. And I'm wondering if, you know, from your understanding as to how this statute came together, you know, if there was any anticipated role that Congress might have considered for tax exempts, you know, in the process of facilitating or monetizing the 45Q credit in particular.
Sure. I mean, over the last however many years clean energy credits have been around, I mean, there's been issues regarding sort of how tax exempts. I mean, really, we're really mostly talking about state and local government owned utilities, electricity generating facilities, or the rural electric cooperatives, who are all, you know, non-tax paying entities, and they couldn't really benefit from these tax credits, so they typically had to go out to the tax equity markets. And so I know over the last few years, they have been working very hard talking to Congress about these issues. And so when direct pay came up as a possibility, that was something that was very important, became very important to those folks to look at, because they really see that as an answer for them to be able to take the full value of that credit and not have to give 20-30% of the credits to the tax equity market. And so we work with a lot of cooperatives and a lot of state and local governments, and they are all very interested at this point, and, you know, very, very much ready to start working on projects and getting these projects out there to be able to benefit from the direct pay.
Okay, great. Thank you. I think we're going to flip now to the DOE and Matt, who's been patiently waiting. Matt, maybe just as a setting of the table, you can briefly describe what programs you are currently offering in the CCS space.
Well, I'm going to speak directly from the Loan Programs Office perspective. There's a lot of programs throughout the DOE complex, but within Loan Programs Office, we have two avenues for funding of loans, direct loans from the U.S. government, or loan guarantees where we can guarantee a commercial bank loan. The first is through the Title 17 program. And that's been with us since the origin of the program in 2005, the 2005 Energy Policy Act. The Inflation Reduction Act added a few elements to Title 17 that are beneficial. The first is credit subsidy. So that's a loan loss payment that historically was required to be paid in cash by the project developer at financial close. But now that cost is appropriated by the U.S. government. So it's no longer a cost that has to be paid by the project. That's helpful. So our fossil solicitation that's on our website would be the place to look for information about eligibility for CCUS projects. And then the 1706 program adds up to $250 billion of loan authority to decarbonize the economy. And we think there's a big play for CCUS in that space as well. And there's $5,000 or $5 billion of credit subsidy. And so that's Title 17. And then we also, as part of the infrastructure law of about a year ago, created the CIFIA program, which is a carbon dioxide infrastructure transportation and innovation program. And that enables us to provide, we estimate between 20 and $40 billion worth of loans to transportation infrastructure projects, which could be pipelines, rail, maritime, road, or any other way of moving carbon from the point of capture to the point of sequestration or end use. We just recently opened up that program for applications, and Title 17 has been open for some time. So visit our website for more information and to request a pre-application consultation.
Okay. So given all of the options now to monetization, does the DOE Loan Program Office have a preferred monetization approach for 45Q?
We don't have a preferred approach. I mean, at the end of the day, as long as the tax credit can turn into cash flow, real dollars that flow through the project's waterfall, we can treat that cash flow as cash flow available for debt service. I mean, we will evaluate the approach to monetization for particular projects and confirm that we're comfortable that it will efficiently convert the credit into sufficient cash flow for our debt service.
Okay, so just a project that's got a single revenue source being the monetization of the 45Q credit is not a problem.
We understand that for many CCUS projects, the 45Q tax credit is the sole revenue source. And so that's something that we're prepared to structure around and that we're comfortable with.
Okay. And your loan requires that you only lend up to 80% of the eligible project costs. And there's a 20% equity piece. In terms of what is an eligible project cost, is that does that sort of align with what is defined as carbon capture equipment, or is it a broader universe of costs?
Well, for a CCUS project, it would naturally include the capture equipment, and there's a broader list of eligible costs that can be included in your total project costs for lending purposes. And the full suite of eligible and ineligible costs are detailed in our guidance documents for Title 17 and for CFIA. So that's why I would direct people to look to have a more detailed breakdown. But generally speaking, you know, your project development costs, your construction costs, your equipment costs are all going to be part of the total project costs that are eligible for borrowing against.
But it would have to be materials that are owned by the borrower, as opposed to, you know, if the carbon capture equipment's owned by somebody, by one entity, and the emitter is owned by a different party, and there's retrofits on the emitter, that wouldn't all be under one loan, presumably.
It could be. I mean, it really depends on the project. Some projects are greenfield projects that are building new plants from scratch that are going to have let's say, an industrial facility with carbon capture built from the ground up. And then that whole project will be financed. Some are retrofits of existing facilities where the CO2 capture island is carved out as a separate entity, and that's the asset that they borrow against. So in that case, it would just be the carbon capture equipment, and there may be hybrids in between.
Okay. Do you need a rating agency to rate the project, the proposed debt, before you issue your?
Sure. For the Title 17 program, we do require a preliminary credit assessment as part of your application, and then a bring down of that credit assessment just prior to financial close. We do not have that requirement for CFIA, and we use those ratings as guides to help us in our underwriting and our thinking of the credit risks. But we have our own internal credit scoring process that we use within LPO and through DOE, and then with our partners at OMB to derive an ultimate credit risk score for particular transactions.
Okay, one final question for you, and then I think I'm going to flip it to the audience. But so this is sort of a bundled question. The timeline that an applicant, you know, should expect when you know, entering into discussions with the DOE, plus when do you advise applicants to kind of line up their 20% equity if they have to go to a third party provider?
All right, well, let me answer the second question first. And first of all, just qualifying that 80% is the maximum amount of debt that we can offer. The ultimate amount that we offer is subject to our due diligence and our negotiations and our evaluation of the cash flow. I think on average, we generally tell people our portfolio is around 65% levered. Our preference is to have the rest of the capital stack lined up as soon as possible, because we like to be able to negotiate with equity at the table, as opposed to us, the lender, negotiating directly with the project developer, and then you run the risk of a very debt-oriented offer that equity investors may have trouble getting comfortable with, it's better to have all parties at the table up front. In terms of the timeline required, it's really project specific. The general message we tell people is you should expect 9 to 12 months between when you come in for an application and the earliest you could possibly expect to reach financial close and a funding decision. The complexity of the project will derive the ultimate amount of time, particularly when we start looking at the CO2 transportation infrastructure and pipelines being an example where we need to do environmental reviews. And those environmental reviews can extend in the 18 to 24 month time frame to get completed. So that's an area where we encourage potential applicants to reach out to us very early if they're considering working with us, so that we can start to have those conversations and hopefully start the NEPA process as early as possible and look for time efficiencies.
Okay. All right. Ruth, why don't we look at questions, and I guess you can monitor, you could direct them to the various speakers.
Yeah. Thanks a lot, Ellen. And we have about 8 minutes left, so we're only going to be able to get to a few questions, but we will be putting up on the screen for you in a few minutes contact information for the panelists, so you'll be able to contact them later or contact the Institute. So we'll probably be able to get to about 3 questions. One of them I'll start with, sort of like takes on the last question. The question is coming from Derek Gonsolin, who's asking, what are developers saying about time-bound claiming of credits? With those projects having such long horizons, lead times, have they communicated concerns about the risk of credits expiring and their projects becoming uneconomic? So essentially, you know, the impact of how long it takes for these projects to get going to be able to take the benefit of the 45Q tax credit. And that anyone from the panelists can answer that?
I'll take a first crack at it. I think what we're generally hearing from project developers is that they are very happy that the construction start date has been extended, because before it was looking very challenging for anyone to get a project complete by the expiration. So at the moment, we're not hearing too many concerns about people being able to reach that time horizon.
Okay.
Yeah, I think, Ruth, I would agree with that, in that, I mean, we now have through 2032 to begin construction on our project, so it's a quite long time frame. The one thing we continue to hear from folks, of course, is that while the 12-year credit window is nice for most of these projects, as has been said, this is the only cash flow for the project. So once that 12-year period's over, you have no revenue coming in. So what's going to happen with that? You're going to be able to get all of your capital back on that carbon capture equipment within that 12-year period. So that is a concern of folks, and there have been talks trying to extend that window, but so far Congress has not shown any interest in doing that.
Okay. All right. There's another question from Keith Cruz, says, additionally, for the non-direct pay portion of 45Q credits, will the losses need to be carried forward and consumed as the project company has the tax appetite to do so, such as a net operating loss carrying forward?
I guess I think what this person is asking, and maybe relates to the point that we were making earlier, which is that these monetization, the ability to monetize the 45Q credits doesn't do anything to change the situation with respect to depreciation expense or other losses that might be incurred by the sequesterer or the capturer. So those credits or those losses would, yes, be carried forward and reflect, NOL on the balance sheet.
Okay. There are 2 questions here related to 45Q and 45V. One is, and I'll try to combine these 2. What is the difference between 45Q and 45V as it applies to blue hydrogen? And then the second one is related to, is there any difference between 45Q and 45V in terms of clawback if there's CO2 leakage?
I can take that one. I mean, it's so really for 45V, I mean, blue hydrogen will receive, I mean, the maximum credit for under 45V is $3 per kilogram of clean hydrogen. But in order to achieve that, you have to have a carbon intensity lower than 0.45%, which is going to be very difficult for any blue hydrogen project to do because of the life cycle analysis that you have to do on the carbon intensity of the natural gas coming in and through the process of producing that. So you're probably not going to get $3. You may get $1, $1.20. Really, what some companies are going to have to analyze, am I better off at that sort of value for each kilogram of clean hydrogen, or is the $85 a ton, assuming I get $85 a ton from 45Q, is that going to be more money than that amount per kilogram of hydrogen? And it really comes down to sort of the operating efficiencies and how they are producing that hydrogen.
On the
For the
recapture front, yeah, I'm sorry, go ahead.
That's okay. I mean, on the recapture front, 45V, because it's a credit for clean hydrogen, it does not include the same kind of recapture requirements that you have under 45V, which actually is a credit for sequestering the carbon dioxide. So they did not include that within 45V.
Ellen, did you want to comment on that also?
Yeah, well, I was just, I mean, the 45V also has a 5-year direct pay component. And it's a 10-year credit period as opposed to a 12-year credit period. So that's some of the distinctions. And I think we don't know enough about 45V really to give too many other answers, because it's one of those credits that has yet to be subject to regulation.
Right. And actually, I think regarding that sort of difference in credit windows, the way the prohibition is written in 45V, it seems to me that you could take 45V for 10 years, and then you could take 45Q for the final 2 years of that credit window.
That's interesting.
So, you know, so I think that is something we don't have guidance on that, but that's the way the law is written. That's what should be what happens.
I agree. Yeah.
Okay.
Ruth, I might just jump in here because I can see these questions, and there's one that I think is important that we get to, and we'll just take a minute. There's a question where they say, what issues might we anticipate over cross-border projects, pipelines into Canada? And I know that we had a lot of, it looked like some Canadians that signed up to view this webinar. And I think it's important, this is not a change from the IRA. This is, the basic 45Q provision, which is that both pieces, the capture of the carbon and the sequestration of the carbon, have to happen inside the US. So if you had a situation where you were capturing CO2 in Wyoming, but then piping it for sequestration or EOR into Canada, that wouldn't qualify for 45Q. So unfortunately, the way 45Q is written, it's only for everything happening inside the United States.
You might also just make the distinction that with respect to clean hydrogen production, you produce it in the United States, but what you do with it after you produce it, there's no limitation. It could go, on a ship and be, sent across the world, or to Canada.
Okay, thank you. We're at the top of the hour, so we will put up now. We'll end the webinar, and unfortunately, we'll not be able to get to the questions today. But what we would do is put up the contact information for our panelists, and then we will get back to you with the answers. I want to thank first all the attendees for attending today and for your participation with the numerous questions that you put into the chat, into the Q&A function. And I want to particularly thank our panelists today for trying to cover such a complicated subject in an hour. It is impossible to do this in an hour. We have so many things that are left, not only because of the time frame, but also we're also waiting on guidance from, IRS Treasury as they talk to their partners of EPA and also DOL. But then again, thank you, everyone. Thanks for being on the panel today, and thank you for participating. Thank you.